Now discuss financial inclusion. So the financial inclusion mainly the process. So it is mainly it ensures financial inclusion. It is the process which ensures access to financial service. So here we can take all the action. It gives access to financial service to all sections of the society, especially vulnerable or weaker sections. So please remember. So financial inclusion is the process which ensures the access to financial services to all sections of the society, especially especially vulnerable or weaker section. So here financial service includes bank accounts, fund transfer facility, and insurance facility, and bank accounts is important, and credit facility, pension facility, all are important. All are financial service. And government measures in the pre-reforms. Government's measures in the pre-reforms era. So here important reforms are like nationalization of banks in 1969. 14 commercial banks were nationalized, and all are government measures. And priority sector lending policy, lead bank scheme, service area scheme, establishment of regional rural banks. NABARD was established in 1982. Cooperative banks, SIDBI, was established in 1989. HG bank linkage groups. SIDBI was established in 1989. SHG bank linkage group. Latest measures by the government to achieve financial inclusion. Latest measures by the government includes. So latest measures by the government to achieve financial inclusion. So no frills account, business correspondent scheme, bank Bathi Yojana, and renamed as Swabhiman scheme, post offices bank scheme, microfinance institution, pension scheme, micro insurance scheme. So all are latest measures by the government to achieve financial inclusion. So please remember. So microfinancial institution, pension schemes, and micro insurance scheme, development schemes from MNREGA. Okay, so here important committee recommendation is Milligam committee recommendation. Milligam committee recommendation MFI. So MFI. So marginal. MFI mainly is MFI. Here you can discuss. MFI should give loans to weaker sections only. Marginal financial inclusion. It is gives loan to the weaker sections of the society only. Which is 50,000. Okay. So and maximum loan 25,000. And selling on interest. So sorry, maximum loan 25 lakh, and selling on interest 24%. Why should MFI charge high interest? Why should MFI charge high interest? Because MFI charge high interest because risk in lending to weaker sections is high, and cost of raising funds for MFI is high, and cost of operation is also high. Cost of raising funds of MFI is high. Risk is high. Okay, so all are important. So here in new pension scheme initiated on January 1, 2004 for central government employees. New pension scheme is based on defined contributions. So defined contribution rather than defined benefit. NPS, so new pension scheme is based on defined contribution rather than defined benefit. Contribution tier 1, tier 2. Tier 1 employees contribute 10% of basic and DA, and government also contributes 10% of basic and DA. Tier 2, this is optional and the employee can contribute any amount. Government will not make any contribution. The money should collected will be invested in securities market. Tier 1 employee contributes 10% of basic and DA, and the government also contributes 10% of basic and DA. This is optional and the employee can contribute any amount. Government will not make any contribution. The money so collected will be invested in security market. Micro insurance scheme Aam Aadmi Bima Yojana, initiated in 2007. It is a life insurance scheme. Aam Aadmi Bima Yojana. Rashtriya Swasthya Bima Yojana, launched in 2007, and it is a general insurance scheme. Rashtriya Swasthya Bima Yojana. And Aam Aadmi Bima Yojana, initiated in 2007. It is a life insurance scheme. And Rashtriya Swasthya Bima Yojana, Aam Aadmi Bima Yojana, a micro insurance scheme, and Rashtriya Swasthya Bima Yojana. Aam Aadmi Bima Yojana initiated in 2007. It is a life insurance scheme. And Rashtriya Swasthya Bima Yojana, it was launched in 2007. It is a general insurance scheme, health insurance scheme. Okay, health insurance. And inclusive growth versus financial inclusion. Okay, inclusive growth is a much broader term. Okay, now inclusive growth versus financial growth. Inclusive growth is a much broader term. It means that the benefit of growth should percolate down to all. So it means that the benefits of growth should percolate down to all. And financial inclusion means bringing all under the financial services which is required for inclusive growth. That is, in other words, nobody is left behind in accessing financial services. Hence, inclusive growth includes within itself financial inclusion. Inflation means increase in average prices of goods and services in a long period of time. Inflation means increase in average prices of goods and services. Inflation means increase in average prices of goods and services in a long period of time. It is a micro concept wherein the effect of inflation is seen over a large basket of goods. Ultimate effect of inflation is that the value of money is reduced. Ultimate effect of inflation is that the value of money is reduced, that is, purchasing power of money is reduced. Please remember, the ultimate effect of inflation is that the value of money is reduced, that is, purchasing power of money is reduced. So inflation means increase the average price of goods and services in a long period of time. It is a micro concept where it is the effect of inflation is seen over a long basket of goods. The ultimate effect of inflation is that the value of money is reduced and purchasing power of money reduced. And in types of inflation, mainly the demand pull inflation and cost push inflation. Demand pull inflation caused due to increase in aggregate demand in the country, in the economy. So demand pull inflation caused due to increase in aggregate demand in the economy, and causes increase in money supply. Here increases in forex reserves and deficit financing by government, increase of exports, depreciation of currency, cost push inflation. So demand pull inflation, now we discuss, and cost push inflation. So cost push inflation caused due to the reduction in aggregate supply in the market. So cost push inflation caused due to reduction in aggregate supply in the economy. Okay, and demand pull inflation due to the increase in the aggregate demand. and causes increase in money supply, increase in money increase in forex reserve, deficit finance by government, increase in of export, depreciation of currency, cost push inflation due to the reduction in aggregate supply in the economy. So it causes increase in price of inputs, hoarding and speculation of commodities, and defective supply chain, increase in indirect taxes, depreciation of currency. Note cost push inflation. Costful inflation is considered bad among the two types of inflation. So because the national income is reduced among the reduction in supply of in cost push types of inflation. Here it is mainly cost due to the reduction of in aggregate supply in the economy. So increase in the price of inputs, and hoarding and speculation of the commodities and defective supply chains, increase in indirect taxes, depreciation of currencies, causes of inflation in recent years. Because some of the important causes are gradual price fluctuation, defective food supply chain, low growth of agriculture sector, and food inflation. Growth of agriculture sector has been averaging at 3.5%. Interest rates was increased by RBI. Causes of demand pull inflation. So causes of demand pull inflations. So causes of cost push inflation now we discuss. Gradual price fluctuation, defective food supply chain, causes of cost push inflation, low growth of agriculture sector, and food inflation. Interest rates was increased by RBI. Causes of demand pull inflation mainly increase in foreign exchange reserves, increase in government expenditure due to the fiscal stimulus, increased borrowing, cost for demand pull inflation. So please remember demand pull. So causes for demand pull inflation are increase in foreign exchange reserve, and increase in government expenditure due to fiscal stimulus, increased borrowing, depreciation of rupees. So some of the important remedies. So monetary policy, contractionary policy, monetary policy, and fiscal policy measures. Fiscal policy measures are also called budgetary policy, or fiscal policy measures are also called budgetary policy. It deals with the revenue and expenditure policy of government. Fiscal policy and tools of fiscal policy are direct and indirect taxes. Direct taxes should be increased and indirect tax should be reduced. Public expenditure should be decreased. Please remember, public expenditure should be decreased. Should borrow less from RBI and more from other financial institutions. Supply management measures. Import commodities which are supply management measures. Import commodities which are short supply, decrease exports. Government may put a check on hoarding and speculation distribution through PDS. Government may put a check on hoarding and speculation and decrease exports. Import commodities which are in short supply distribution or through PDS. Government may put a check on hoarding and speculation, decrease exports. Import commodities which are in short supply distribution among PDS. So all are supply management measures. Import commodities which are in short supply, decrease export. Government may put a check on hoarding and speculation. So it all are important. Please remember. So taxation. Next, our taxation. In order to run the government and manage affairs of a state, money is required. So the government imposes taxes in many forms on the incomes of individuals and companies. So in order to run government to manage affairs of a state, money is required. So the government imposes tax in many forms. So please remember, government imposes many. So government impose many forms of on the income of individuals and companies. Broadly, taxes are divided into two categories: direct tax and indirect taxes. Direct tax mainly a tax is paid directly by an individual or organization to the imposing entity, generally government. It is generally government. A direct tax cannot be shifted to another individual or entity. A direct tax cannot be shifted. So please remember, a direct tax cannot be shifted. So direct tax cannot be shifted to another individual or entity. The individual or organization upon which the tax is levied is responsible for the fulfillment of the tax payment. Indirect taxes, on the other hand, can be shifted from one taxpayer to another. The individual or organization under which the tax is levied is responsible for the fulfillment of the tax payment. Indirect taxes, on the other hand, can be shifted from one taxpayer to another. A taxpayer pays a direct tax to a government for different purposes. A taxpayer pays a direct tax. The taxpayer pays a direct tax to a government for different purposes, including real property tax, personal property tax, income tax, tax on assets, FBT, gift tax, capital gain tax, etc. Indirect tax. The term indirect tax has more than one meaning. Please remember, it has more than one meaning. Okay. So in the colloquial sense, as an indirect tax such as sales tax, a specific tax, value-added tax, or good GST is a tax collected by an intermediary such as a retail store from the person who bears ultimate economic burden of the tax, such as consumer. The intermediary later files a tax returns and forward the tax proceeds to government with the return. In this sense, the term income tax is contrast with a direct tax, which is collected directly by the government from the person on which it is imposed. Some of the important direct taxes are like fringe benefit tax. So in order to reduce the profit on booked entity, in order to reduce the profit on book entity, many companies started providing various benefits to their employees and maintain them under their input cost, thus reducing the profit, which is turn leads to less taxation by the government. Therefore, government imposed fringe benefit tax, which is fundamentally a tax that an employer has to pay in lieu of the benefits that are given to his or her employees. It was an attempt to comprehensively levy tax on those benefits which evaded the tax. The list of benefits encompassed a wide range of provided privileges, services, facilities, and or amenities, which were directly or indirectly given by an employer to current or former employees, be it something simple like telephone reimbursements, free or concessional tax tickets, or even contributions by the employer to a superannuation fund. Fringe benefit tax was introduced as a part of the Finance Bill 2005 and was set at 30% of the cost of the benefits given by the company. This tax needed to be paid by the employer in addition to the income tax, irrespective of whether the company had an income tax liability or not. So FBT, fringe benefit tax, was introduced as a part of Finance Bill of 2005 and was set at 30% of the cost of the benefits given by the company. The tax is needed to be paid by the employer in addition to the income tax, irrespective of whether the company had an income tax liability or not. Fringe benefit tax was abolished in the 2009 Union Budget of India. Next, minimum alternate tax (MAT). Next, then alternate minimum tax. So indirect tax are like production of goods, exercise in VAT, distribution of goods, sales tax, service tax, distribution of service production, excise duties, important sales tax, service tax, VAT, taxation system like VAT, GST. Okay, so all are important. So now we come to here, fringeal tax. Now a minimum alternate tax, second direct tax. Minimum alternate tax is like the concept of minimum alternate tax was introduced in the direct tax systems to make sure that companies having large profits and declaring substantial dividends to shareholders, but who were not contributing to the government by way of corporate tax by taking advantage of the various incentives and exemptions provided in the Income Tax Act and pay a fixed percentage of book profit and as minimum alternate tax. As per the Income Tax Act, if a company's taxable income is less than the certain percentage of the booked profits, then by default that much of the book profit will be considered as taxable income, and tax has to be paid on that. It is called MAT and is a direct tax. It was introduced in order to deter some companies who managed their accounts in such a way that they end up paying zero or no tax to the government. Current rate of MAT is 18.5% alternate minimum tax. So under the existing provisions of the Income Tax Act, minimum alternate tax MAT or an alternate minimum tax are levied on companies and limited liability partnership respectively. That means what is MAT to the company's AMT in the LLP. What, I don't know actually. क्या हो रहा है, क्या कितना बड़ा बड़ा करके लिखा हुआ है उसमें मेरा भी समझ नहीं आ रहा है, अभी मैं पढ़ रहा हूँ. ओके सो कितना ज़्यादा इसको याद रखना बहुत ही मुश्किल होता है, समझना पड़ेगा थोड़ा. So alternate minimum tax, however, no such tax is levied on the other form of business organization such as partnership, firms, sole proprietorship, proprietorship, association of persons, etc. Indirect taxation in India: production of goods, excise or VAT, distribution of goods, sales tax, production and distribution of service, because they cannot be separated, service tax. In India, generally taxes on production or manufacturing is levied by the center and taxes of sales tax, excise duties, central VAT. Here you can see. So it is a tax on manufacture of goods within the country. Excise duties are levied under Central Excise and Salt Act 1944, the Excise Tariff Act 1985, and the Modified Value-Added Tax. Mod VAT scheme or state VAT. The rates of excise duty levied vary depending upon ALIA on the nature of item manufactured, the nature of the manufacturing concern, and the place of ultimate sale. The duty rates are either ad valorem, that is fixed percentage of the cost of production, and specified a fixed rate depending on the nature of the manufactured item. The example: length of production, product or count of product, or a combination of both. The Mod VAT scheme introduced in 1986 on the recommendation of L.K. Jha committee applies to certain specific items. Mod VAT means modified value-added tax. The objective of this scheme is to limit the cascading effect of duty incidence on a number of goods and subject to excise, which are further used as inputs for other excisable goods. Under the scheme, mode VAT credit can be claimed on the purchase of raw materials on which excise have been paid. The mode VAT credits can be used to set off excise duty payable on subsequent manufactured on goods. Sales tax is levied on the sales of the commodity which is produced or imported and sold for the first time. It is a product sold subsequently without being processed further. It is exempt from the sales tax. Sales tax is levied by either the central or state government. Central sales tax or 4% is generally levied on all interstate sales. State sales tax that apply on sales made within state have rates that range 4 to 15%. However, exports and services are exempt from sales tax. Service tax is a part of the central excise in India. It is a tax levied on service provided in India, except the states of Jammu and Kashmir. The responsibility of collecting the tax lies with the Central Board of Excise and Custom. Taxation system: VAT, value-added tax. Value-added tax or VAT is an indirect tax which is imposed on goods and services at each stage of the production, starting from raw materials to final product. VAT is levied on the value additions at different stages of production. It is an indirect tax which is imposed on goods and services at each stage of the production, starting from raw materials and to final products. VAT is mainly levied on the value addition at different stages of production. VAT is widely applied in the European countries. However, now number of countries across the globe have adopted the tax system. Goods and service tax, which is to be implemented in India, is nothing but a kind of VAT system. GST. Now we discuss. GST, the goods and service tax, is a value-added tax to be implemented in India. The reason on which it is pending, it will replace all the indirect taxes levied on goods and service by the Indian central and state government. It is aimed at being comprehensive for most goods and service with few tax exemptions. Okay, so it is a value-added tax. Goods and service tax is a value-added tax implemented in India. Okay, the decision on which is pending, it will replace all indirect taxes levied on goods and services by the Indian central and state governments. It is aimed at being comprehensive and more for most goods and services, and with few tax exemptions. India is a federal republic, and the GST will thus be implemented currently by the central government and state government at the central GST and state GST respectively. The implementation as the central GST and the state GST, the implementation of the GST will lead the abolition of other taxes such as octroi, central sales tax, state level sales tax, entry tax, stamp duty, telecom license fees, turnover tax on consumption or sales, or the sale of electricity, taxes on transportation of goods and services, etc., thus avoiding multiple layers of taxation that currently exist in India. Advantages of implication of GST in India. Advantages of implication of GST. It will boost of economic unification of India. It will assist in better conformity and revenue resilience. It will embed the cascading effect in indirect tax regime. In GST system, both central and state taxes will be collected at the point of sale. Both component, the central and the state GST will be charged on the manufacturing cost. It will reduce the tax burden for consumers. It will result in a simple, transparent, and yet easy tax structure, merging all levies on goods and services into one GST. It will bring uniformity in tax rates, which only one or two tax rates across the supply chain. It will result in a good administration of tax structure. It will broaden the tax base. So GST, here you can see GST system, both central and state tax will be collected at the point of sale. Both components, central and the state GST, will be charged on the manufacturing cost. It will reduce the tax burden for consumers. It will result in a simple and transparent easy tax structure. Okay, merging all the levies on goods and services into the GST, into one GST. It will bring uniformity in tax rates with only one or two tax rates across the supply chain. It will result in a good administration of tax structure. It may broaden the tax base, and it increases tax collections due to the wide coverage of goods and services. It will result in cost comprehensiveness of goods and services in global market. It will reduce transactions cost for taxpayers through simplified tax compliance. It will result in increased tax collection due to wider tax base and better conformity. Limitation of implementing GST in India. Experience of various countries shows that it is very difficult to manage GST system. Even various developed countries find it difficult. Okay, and it's difficult. India's tax collecting authority is not equipped technically to handle it, and computerization of data is needed. So all are limitation, and its resource intensive at large data collection is required. Amendment of constitution is required, for which concession of at least half of the state is needed, which is very difficult in today's rise of regional politics. Laffer curve invented by Arthur Laffer. This curve shows the relationship between tax rates and tax revenue collected by government. So the curve suggests that as taxes increase from low levels, tax revenue collected by the government also increases. It also shows that tax rates increasing after a certain point would cause people not to work as hard or not at all, therefore reducing tax revenue. So Arthur Laffer, this curve shows the relationship between tax rates and the tax revenue. So here tax rates and tax revenue relationship. The curve shows that as the tax increases, here tax increases, and from low levels, tax revenue collected by the government also increases. Please remember, in this diagram, it also shows that the tax rate increasing after a certain point would cause people not to work as hard or not at all, thereby reducing tax revenue. Eventually, if tax rates reached 100%, okay, the far right of the curve, then all people would choose not to work, because everything is easy, everything they earned would go to the government. So it is very, very important. It is called Laffer curve. So now we discuss all the thing. So next we discuss another. Okay, so